Is everything money right about Walgreens? Let's talk about that. Hey guys, I'm the Newb investor. Today we'll be looking at Walgreens, ticker symbol WBA. I don't know what their average price is, but they claim to have bought WBA, so let's see if WBA passes my three metrics. WBA is currently trading at 46.61 US dollars, with the highest price of 96.68 in 2015. That is 51.79% from the highs. Market cap of 40.24 billion with PE of 6.29, EPS trailing 12 months of 7.42, and gives out an annual dividend of $1.91, a yield of 4.1% of the current price. Let's go to the first metric. First metric, we want an EPS multiple of less than 3. WBA's current PE ratio is 6.29. EPS is 7.42. If we divide the current PE by the EPS, we'd get 0.85, meaning we're buying WBA at these discount prices at just 0.85 of their current earnings. They do a good job of buying back shares. Next metric, we want to pay $1 or less for a percent of what they're earning. But first, let me explain the table. You'd see here on the left are COGS, OE, NI, and FCF. Those are revenues, cost of goods sold, operating expenses, net income, and free cash flow for the last 5 years. FCF is cash from operations less capital expenditures. Below are its respective percentages relative to the revenue. Let's take a sample. In 2021, WBA spent 104.44 billion of 1.32.51 billion of revenue in COGS. That is 78.82% of the total revenues. 24.4 in OPEX or OE, 18.42% of the revenues. They made 2.54 billion in net income. That is 1.92% of the revenues. And finally, made a free cash flow of 4.18, which is 3.15% of the revenues. Do this to the previous 5 to 10 years, your preference. The more data, the better, but for this video, I'd only do 5 years of data. Next is to take the latest year's data and the averages of 5 and 10 years and take the lowest value in the data. Why? Because we want to start our assumptions at the lowest value in respect of what they're making. In here, we have 1.92. Use this to divide the current PE of 6.29, and that's our discount. Actually, if we use 1.92% of the revenues, which is their net income in 2021, we'd be overpaying 3.28 times of what they're making or what they made. Now, this happens a lot when we're screening companies with low profit margins. So what I did here is we take the highest of the 4 highlighted values, which is 4, then use it to divide the current PE, and we'd get 1.57 times. We're still overpaying for what they're making, but it doesn't mean it's not a buy. Next metric is historical PE. I took the values where the PE trades around an area of consolidation. In the table, you will see the number of quarters I used to take the average PE from. Here, you'd see 38 quarters with the lows of 5.29, around where we're trading right now, and the highs of 16.98. With the average of 13, the 494.17 here is the sum of the PE in 38 quarters. Now, we want to use 13 to divide our current PE, which is 6.29, and we'd get 0.48, meaning we're buying WBA now at a discount compared to how it was valued years before. The problem I saw in this stock is that the PE just compensates when the EPS is either high or low. The current PE now is just 6.49 because the EPS is high. When the EPS drops, the PE rises. Something to consider because if this continues, I don't think the stock will go anywhere. But we'll just continue to adjust the prices to justify EPS and PE. I don't think them beating estimates would push the stock price higher. To conclude, here's our metrics and our results. For companies with low profit margins, you want to buy them at very conservative PEs. My entry points here are 4, 6, 8, but Even for me, that's a little high. Maybe use 4, 5, 6. If I had a say in the company, I'd lose the dividends and aggressively buy back shares because the markets clearly don't value the stock much. I've included here the shares outstanding. It's in billions. They are buying back shares, but for me, they gotta do more. I think this is a good buy to start a small position, then buy more as it goes lower if you really believe in the company. If everything money bought WBA below 40, I think they're right buying it at low PEs. If you want to invest in these companies, I'd advise you to use a higher time frame of 10 years of data or more. Also, look at the other metrics like long-term debt, current ratio, etc. As usual, do your own research.